Welcome back. Now, Karvy Private Wealth has released its 5th annual edition of the India Wealth Report, which analyzes holdings of wealth with Indian individuals as of 31st March. Now, to discuss this, we've got Sunil Mishra with us. Sunil, what are some of the findings this time around? What's actually struck out? Talk us through the highlights.
Yeah, sure. This is the 5th edition of Karvy's India Wealth Report, and we are happy to be sort of continuing this year on year. This time we have put out a figure of 257 trillion rupees, 257 lakh crore of rupees as the total wealth in the hands of Indian individual investors, and this is across asset classes. Out of 257 trillion, we show that 135 trillion is held in financial assets and 122 trillion is in physical assets. So in financial assets, 29 trillion is in fixed deposits, 27 trillion is in direct equity, etc. And in physical assets, 62 trillion is in gold. So gold continues to be the single largest sort of product in terms of wealth held by Indian individuals, followed by real estate, 50 trillion, which is the sum of the values of the second home, third home, fourth home, etc., excluding the primary residence. So that's the overall sort of numbers, but the bigger story is the rate of growth of equities in the entire wealth pie, and we forecast that by FY15 direct equities will overtake fixed deposits to be the #1 product in financial assets. So that's the overall picture that we have put out in Karvy's 5th edition of the India Wealth Report.
Was retail investment, Sunil, this time in equity much higher versus some of the earlier years?
Definitely, that there's a smile on all our faces, and there's a reason for that. Investments in equities have increased over the last sort of 12 to 14 months now. And what happened in the 5-year period from 2008 to 2013 is hopefully not going to get repeated. So as per the data, yes, increasingly Indian investors are putting more monies in equities. In fact, we are sticking to our report that Karvy Research had set out a few months back of saying that the Sensex will touch 100,000 by 2020, and for that to happen, the CAGR of 25% has to be reached. We are seeing this already. Because of this, we are also seeing a change in the mix of financial assets versus physical assets, which used to be 50-50 about 10 years back, but has dropped down to a 69-31 number in 2012. We see that reverting back to the original 50-50, and by 2018 we feel that 50% of Indian savings will go into financial assets and 50% into physical assets.
Now, Indian investors do have a strong preference for gold as far as an asset is concerned, and we've all seen what's happening to gold prices. What's your outlook on that front?
You are bang on. There is a whopping 62 trillion of wealth out of the 257 trillion of Indian individuals which is invested in gold, and that is easily the Amitabh Bachchan of investment in India. However, what happened in the first 60 years is sort of slowing down. Last 6 months we have seen this grow at a very low pace. We feel that as the markets improve, as the global conditions improve, gold, the attractiveness towards gold will be lesser to that extent. The fetish for Indian jewelry, etc., will continue to remain the same, but over the next 20-year period, I see that also reducing as families become more nuclear. Children start getting married on their own, and people don't have to save for gold for children's marriages. There's a cultural, socio-cultural change also that's going to happen. So gold is going to be less attractive as we become more developed as a country. The society structure changes, and most importantly, the returns from equities and other products on the financial side improves.
So what's holding back investors from markets at this point, and do you really expect to see higher flows next year given the kind of levels that we're already trading at?
So multiple reasons why people have historically favored fixed deposits and other debt instruments over equities. One is that they are Indians as a race were pretty risk averse, and we cannot blame us as a race because we were a poor country. If we have only this much money to invest, we are not going to take risks with that. But as the country becomes richer, last 20 years we have seen so much of wealth accumulation, people start understanding that fixed deposits less inflation is a negative return. As the products become more transparent, mutual funds are one of the most transparent products in the world. As fewer and fewer fly-by-night operators come and do an IPO, the aversion towards equities will reduce. Distribution of products also has to increase. Like today, 89% of mutual fund AUM is in the top 15 cities. So the financial intermediaries, the AMCs also have to make a move outside the top 15 cities. And a marriage of these factors, that is the industry reaching out to people and a few of the enabling transparency factors panning out, will sort of pave the path for equities really moving up faster than it did before.
All right, we'll leave it there. Thanks so much for joining us today, Sunil, and talking us through the latest highlights of that report. Let's also take you through one of our top stories once again, the Patiala Court's observations in the Hindalco